Welcome to another episode of Living Fire. Subscribe now so you never miss out on any of our latest uploads. Well, let's get into the video. One of the most fundamental ways in which the wealthy think differently about money is that they don't go out and work for their money. Their money works for them. While they're playing with their kids, teeing off, or hiking in South America, they're earning money. Therein lies the beauty of passive income. It streams in without you having to lift a finger. Investing for passive income doesn't just serve your long-term financial goals. Your investments can earn you income right now. Sources of passive income. Passive income sounds great, but where does it come from? Well, you can earn passive income from many sources, but they all share one thing in common. They require money, work, or both to create. You invest these up front, and then you get to reap the benefits. So this is precisely why so few people earn passive income. They lose interest when they realize how much upfront investment it requires of them. If you're not afraid of a little investment of time or money, watch on and pick and choose a combination of the best passive income sources to fuel your adventures for the rest of your life. Number 1, dividend-paying stocks and funds. One of the simplest and most common forms of passive income is dividends from stocks, mutual funds, or exchange-traded funds, or ETFs. You buy a share and that share pays you a dividend each quarter indefinitely. Some stocks pay higher dividend yields than others, of course. One stock may pay an annual yield of 1% of its share price, while another pays a yield of 5%. So to reduce the risk in your stock portfolio, consider buying ETFs that own a wide range of dividend-paying stocks so that you don't overinvest in any one company. There are hundreds of ETFs that specialize in high dividend stocks. 3 good examples are SPDR S&P Dividend ETF, SPDR S&P Global Dividend ETF, and ProShares S&P 500 Dividend Aristocrats ETF. With their high liquidity, easy diversification, strong historic growth, and low initial cash requirement, stocks remain an easy starting point for passive income investing. Open a brokerage account if you don't have one already. It takes all of 5 minutes. There are several brokerage accounts out there that offer a cash bonus or a stock up to a particular amount for opening a new account. As a final perk of stocks and index funds, you can easily invest in them using retirement accounts such as IRAs. You can open them through your existing broker, and you maintain full control and ownership over them as you change jobs. Number 2, bonds. The other classic paper asset. Bonds typically pay out interest payments until they mature, and you get your initial money back. If you're new to the concept of bonds, they're basically a loan from you to a borrower, which you can sell on the secondary market to another investor at any time. Bonds come in 2 fundamental forms: government bonds and corporate bonds. Some government bonds, including many local municipal bonds, come with tax benefits for investors. In recent years, bonds haven't paid out the same high returns as they did in the 20th century. In an environment of perpetually low interest rates, many investors have a hard time getting excited about bonds. But still, bonds have historically played an important role in reducing sequence of returns risk for retirees. Because bonds tend to be lower risk, lower return investments, many investors gradually buy more bonds as they approach retirement as a strategy to reduce risk through their asset allocation. Number 3, rental properties. Rental properties are a great source of passive income. They generate ongoing income without you having to kill the golden goose and sell off any assets. That means you don't have to worry about safe withdrawal rates or sequence of returns risk as you approach retirement, at least not for your rental income. In fact, real estate assets drive your net worth higher over time as the properties hopefully appreciate in value and your tenants' rent payments pay down your mortgages. Rents also adjust for inflation, so you don't have to worry about inflation diminishing your returns. The returns are predictable because you know the purchase price of the property and the market rate for rents, and you can accurately forecast the long-term averages of all expenses. Landlords can mitigate the main risks of rental properties through aggressive tenant screening and rent default insurance, and through property management best practices, including semi-annual inspections. And as a cherry on top, real estate comes with outstanding tax benefits. Plus, no one says you have to rent to full-time tenants. Alternatively, you can rent your property short-term on Airbnb. But that said, rental properties aren't a good fit for everybody. They require skill and knowledge to invest in profitably, which is precisely why so many new rental investors end up losing money. Rental properties also require many thousands of dollars of cash up front, in the form of a down payment and closing costs, which makes diversification a challenge at first. Real estate is also notoriously illiquid. It costs a great deal of money and time to cash out your equity by selling. Only invest in rental properties if you're genuinely interested in learning the ropes and making a hobby or business out of it. If you're only interested in diversifying your assets, you have plenty of easier options for gaining exposure to real estate, including real estate investment trusts, or REITs. Number 4, public REITs. Through your brokerage account, you can buy publicly traded REITs, just like stocks or ETFs. That makes them the most liquid option for investing in real estate. Unfortunately, it also makes them the most volatile. The SEC requires publicly traded REITs to pay out 90% of their profits in the form of dividends. That means REITs tend to pay high yields, but it's difficult for REIT managers to grow their portfolios, which limits REIT's growth potential. If you want a fast way and easy way to diversify your portfolio and add real estate, public REITs are a simple first step. But because they trade on stock exchanges, they tend to move more in line with stock markets than other real estate investments, limiting their upside as a diversification strategy. Number 5, private REITs. Private REITs are another story. These privately owned funds typically invest in commercial real estate, often apartment buildings, and allow individual investors to buy shares in the funds. Unlike publicly traded REITs, private REITs don't offer much liquidity. Most funds clearly state that they represent long-term investments, often 5 years or longer. Some allow investors to sell their shares early, but usually with a penalty. For investors who don't mind parking their money and leaving it, private REITs offer a great option for passive investing in real estate. Number 6, crowd-funded real estate loans. Another indirect way to invest in real estate is investing solely in real estate secured debt. In the past few years, a wide range of real estate crowdfunding websites have arisen that don't invest in real estate directly at all. Instead, they serve as hard money lenders, making short-term purchase rehab loans for house flippers. These sites lend money for a flipper to buy and renovate a house. Then they recoup that money through investors like you. In many cases, they let you pick and choose individual loans to fund, and they pay interest based on the degree of risk in each particular loan. Number 7, private notes. A private note works similarly to real estate crowdfunding, but without the lender as the middleman. Instead, you directly lend money to another person or company. Ideally, this is someone you know and trust implicitly, because if they don't pay you back, you don't have many options at your disposal beyond guilt-tripping them. Number 8, business income. Starting a business allows you to leverage other people's time and money to create your own passive income engine. What starts as a hobby business can evolve into something larger and more complex that takes on a life of its own. And a successful business continues generating money even after you hire someone else to run it for you. So, explore some potential hobbies you could grow into a money-making business and build your own empire that endures even after you bow out. Number 9, literal income generating machines. Still looking for passive income ideas? Consider actual income producing machines, such as laundry machines, ATMs, arcade games, bar games, or vending machines. The hard part of this strategy is finding a building to agree to let you install your machines. From there, you simply have to service them occasionally to keep them running and periodically stop by to collect your coins. It's not a bad gig, and it's one you can delegate to employees relatively easily. You may need to pay your salespeople a residual commission to sweeten the deal and get them hustling for you though. Number 10, residual sales income. Some sales jobs pay ongoing residual commissions, not just a one-time commission. You bring in a client once, but keep getting paid as long as that client stays with the company. For example, some life insurance salespeople are paid both an initial commission on a sale and a percentage of the policy's monthly premium every month, one that the client pays until the policy ends. Although, you probably shouldn't choose your career based on the commission structure. Residual commissions do create passive income for some salespeople. In some cases, salespeople only earn residual commissions for as long as they continue working for the company. But other companies keep paying residual commissions even after employees leave, giving them a runway for an easy landing in retirement or for entering a new career. And with that, we've reached the end of this video, all about how to invest for a monthly paycheck. If you enjoyed this episode and you found it helpful, don't forget to give us a thumbs up and to subscribe to our channel for more content just like this. Thanks for watching, and we'll see you in the next one.